thank you for joining us for the first module of Understanding Money. This three-part education program will provide you with an understanding of how money works in our economy and how it impacts you. You often hear that interest rates are high or low or inflation rate is high. But what exactly does that mean? And more importantly, why do these things matter? This program, as mentioned, is broken down into 3 bite-sized modules. The first one is to help provide an understanding on interest rates. The next one is on inflation, and the last module looks at the relationship between the two. At the end of each module, there will be a short quiz. After successfully completing each module's respective quiz, you will earn a certificate of completion for this program. Each module is approximately 5 to 7 minutes long. Let's get started. Let's start with the fundamentals. What exactly is the definition of an interest rate? The interest rate is the amount a lender charges you as the borrower. The rate is a percentage of the principal, which is the amount loaned. For example, you take a loan to purchase a car and the amount you need is 2 lakhs. To borrow that, the lender in this case is the bank, is lending you the money at 4% interest rate. The principal is 2 lakhs and the interest rate is 4%. You are the borrower and the bank is the lender. Now, an interest rate can also apply to the amount earned at a bank. So this is money you get on your savings or perhaps even from your investments. Again, as an example, you have a savings account and have 1 lakh in savings. You earn interest on the money in your savings account. Now, likely, it's not a very high amount, but nonetheless, you do earn interest. So interest works both ways, either in what you pay on your debt or what you earn on your savings and investments. The rate of interest, and ultimately the dollar amount of interest we pay, has a number of challenges and opportunities for each of us. For example, we have all heard that credit card debt is one of the worst debts. Why is that? It's because there's a very high interest rate tied to them. So if you're not paying off your credit card in full, the interest continues to rise, making your monthly payments higher and higher. This limits your cash flow as you are having to use more money each month to pay just the interest, thereby making it harder to bring the debt itself down. Interest also impacts what you can afford, and something that is often overlooked during large purchases. I will go back to the car purchase example. We may be able to afford taking a 2 lakh loan and making payments on the 2 lakhs over the time period of the loan. But what is the interest rate and how much are you paying each year? The car that you are purchasing is no longer a 2 lakh rupee purchase. It may be a 2.4 lakh rupee purchase. Can you afford that, or is it outside your budget? Which takes us into our next point. Often when budgets are created, interest payments on debt is not being taken into account. Ensure you manage that within your budget, as paying off the debt is not always as straightforward as paying down the principal amount of debt. The last one is the opportunity cost. This is for those who don't save their money in a savings account or don't yet invest. As we discussed, there is an opportunity to earn money on your savings and investments. By keeping cash at home under a mattress, you miss out on earnings, this interest revenue, and the opportunity cost of that over a period of time could mean the difference between achieving a goal or actually not achieving a goal. Now, before I go any further in explaining how interest rates work, I would like to introduce you to the Reserve Bank of India, referred to as the RBI. The RBI is the institution that makes a difficult decision on how to manage our economy. They are also the main institution that uses monetary policies to determine interest rates. With respect to monetary policy, you can see a definition there on the slide. What I would say is think about it this way. If the economy is not doing so well, like it struggled during the pandemic, what happened? The interest rates were lowered. They do this so that the consumers have more money in hand and will feel more comfortable to spend. If the economy is doing very well, people are spending. Then interest rates go up. not to stop people from spending, but more like to control inflation. We will talk about this more in the next module. For now, the main takeaway is that the RBI is the primary group making the decision on whether the interest rates go down, stay the same, or go up. Now, when we say the RBI makes the decision on interest rates, they're setting the repo rate. The repo rate is the rate at which the RBI lends to banks. Nothing is free. Banks don't just get the money, they must borrow from the RBI at the repo rate. The bank then takes the repo rate and adds their profit margin to decide what rate they will lend to you or pay you. So if the RBI brings down the rate at which it lends to your bank, then the bank will likely be able to pass on this benefit to you. Which is why you see your interest rates go down when the RBI says they are decreasing their rates. But if the RBI decides to increase the repo rate, then your bank would also have to increase the interest rates on what you borrow in order to maintain profit margins. Now, the bank adds their profit on the repo rate and decides what rate they will lend to you. Only if it was that simple, right? There's a bit more to it. Other factors are considered in the specific interest rate before the bank will lend to you. They will look at your credit score. This is a 3-digit number that scores you on your credit history and indicates your ability to repay the loan. Essentially, a higher credit score increases your chances of getting a favorable rate of interest. The type of loan also matters in deciding your rate. Depending on the loan, the bank may look to see whether your loan is backed by any form of collateral, which is known as secured debt. And if it's not backed by collateral, then this is known as unsecured. Unsecured is usually riskier and generally then carries a higher interest rate. Your level of income will also be considered for obvious reasons. This indicates your ability to repay a loan. So this will be considered in deciding the rate at which the bank will lend you the money. Some key things you need to know. We did talk about what the principal was, which is the amount you are borrowing or perhaps saving or investing. Another key definition you likely know is the term. This is the length of time for your loan or investment. Now there are two key types of interest calculations known as simple and compound. Simple interest is only on the original principal amount. For example, if you have rupees 1,000 principal in savings with a 3% annual interest rate for a term of 5 years, you will earn 30 rupees, which is 3% of 1,000 rupees of interest per year for a total of rupees 1,150. Compound interest has a bit more to it and is not as straightforward. Compound interest is charged on both the original principal amount and any interest previously accrued, meaning it's interest on interest. For example, let's look at the same 1,000 rupees with a 3% annual interest rate for 5 years with compound interest. Your principal would earn 30 rupees in the first year. In the second year, you'd earn interest on the new total of 1,030 rupees, which would be 30.90 rupees. Then 31.82 rupees in the third year, and so forth. With that, we will end the module here. Good luck on your quiz, and I look forward to seeing you in module 2 to get an understanding on inflation. Thank you. Question 1. Which of the following is not used to determine your interest rate? A. Type of loan. B. Favorite movie. C. Level of income. D. Credit score. Question 2. True or false? Principal is the base amount of money that you are either borrowing or investing. A. True. B. False. Question 3. True or false? The Reserve Bank of India RBI determines interest rates based on feedback from major commercial banks. A true, B false.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.